So who's going to fold first then? Is it going to be Xi? Is it going to be Trump? Or is it going to be Powell?
I don't imagine that China would crack under pressure, especially as they know that the pressure from the bond markets, I'm not talking about the stock market that much, could lead both President Trump and Chair Powell to think twice before raising the odds further.
Welcome to You're in Business. Markets are in turmoil, investors are on edge. So the perfect time to bring in Maurice Gravier. He's the Chief Investment Officer at Emirates NBD, which is Dubai's biggest bank. Welcome, Maurice.
Thank you for having me, Youssef. And I would say, what a time to be alive, because it's actually changes that are affecting probably much more than just markets. Very happy to be with you.
So U.S. President Donald Trump caved in a little bit to an anxious stock and bond market. Clearly, though, regardless of what asset class you're looking at, this is far from over. I want to start off with the China-U.S. divide. Are we going to see more tit for tat in the coming days?
Well, let me be very frank. It appears that China is the main reason why all this tariff stuff was happened, and this was, by the way, at the very heart of the campaign of President Trump. So shouldn't be a surprise now when we see the level of retaliation and where it took us in terms of rates. Frankly, we are reaching levels that are simply absurd from an economic point of view. And my hope is that at some point, they will not stay as they are. I mean, we're talking 3-digit level rates between tariff rates between the world's two largest economy, one of which being the factory of the world and the other being the temple of consumption of the world. So it's not viable to stay at these levels. That's my belief and my hopes. But I understand the logic and factually, President Trump was elected partially to do that.
The thing to remember is that the rhetoric is still very, very heated. One of the last things he talked about is potentially delisting Chinese companies in the United States. I mean, every time we thought that we've already reached extremes in scenarios, he keeps coming up with new stuff.
Yes, that's. I would say that's probably the most worrying part is that at some point nobody wants to back off, and the Chinese authorities are not known to lose face easily, and so is Mr. Trump. My hope is that at some point it becomes more reasonable, because frankly, yes, the US is the world's largest economy. Probably in 10 years from now, China could be. I mean, they're talking about a huge partner, and I think that we are more talking about rhetoric. And again, I hope that they will speak and find a common ground to make things more reasonable. I'm not talking about zero tariff and a free trade agreement. This is not certainly not what's going to happen. But I think the reciprocal damage would be very high. And there is one key difference between China and the US is that there is no midterm election in China in 2 years.
I'm looking at the market moves, especially in the $7.5 trillion a day currency market. The dollar getting sold and sold hard. It's fallen 7% since the U.S. president's inauguration. Clearly, Bessent and Lutnick want the greenback to be weaker. Is there a dollar range where you would say, you know what? This makes sense for not just the U.S. economy, but the global economy. Maybe it is a weaker dollar. Are we still in that range?
It's an excellent question first, and you're absolutely right. All the market developments that we see are not adverse to the objectives of the America First platform. We're very clear, and a weaker dollar is part of it, as are weaker oil prices. In terms of level, I think it's absolutely fine. The issue is the pace, and to some extent, the issue is also the pace combined with the fact that you see rising treasury yields and it begins to look like a defiance against U.S. assets after having had decades of maybe excessive love for U.S. assets, and this space is a bit of a worry because it could create some some serious disruptions in the global market. It's the same for the U.S. Treasuries. They are not just the U.S. sovereign debt; they are the collateral of reference for everyone. So it's more a matter of a pace, because the U.S. dollar was and still is arguably overvalued in terms of purchasing power parity, and it has been for very long. And you know that the U.S. dollar is much more than just the currency of the United States. It is reserve currency, and this status is probably a bit challenged. It is a trade currency. This status will be more and more challenged, and it used to be a safe haven asset, which it is a bit less currently. It's acting a bit like a risk asset.
You say it used to be. I mean, so there's a transition underway now, so that is going to affect as well how central banks look at their reserve assets, and they're probably also reconsidering, how many dollars they want to hold. So are the inflows into other currencies less about the opportunities there than it is about lost confidence in U.S. leadership?
It is the direction that we can... It is what we can suspect. It's not happening in huge magnitude. What is happening for a few years, by the way, is that gold is probably the new standard reserve assets for central banks, the new risk-free standard asset for central banks. And it's not about President Trump. It started way before, and to some extent, when the assets of the Russian central banks were frozen a bit everywhere, that's probably for me a kind of a turning point. When suddenly you think, okay, we knew that there are strings attached to trading in US dollar, but suddenly we're talking about the sovereign assets of a country, and I think this dynamic started to favor gold. Now, looking forward, is there one alternative currency that could have this role? Frankly, I don't think so. There would be the Swiss franc, which is way too small. I mean, in terms of intrinsic quality and probably the underlying ecosystem, the state of law, this kind of thing, but it's way too small. The yen, the level of debt of Japan, and the euro, it was the dream of the euro to replace the dollar as this, but I don't think that the euro has many reasons to be to play this role. So we still need one reference currency. It's still the dollar. There is no alternative apart from gold for central banks. It's just a matter of dynamic. It's not a no-brainer anymore. Okay, just put some treasuries. Just again, let's be a bit diversified.
So who's going to fold first then? Is it going to be Xi? Is it going to be Trump? Or is it going to be Powell?
In our global investment outlook that we called Winds of Change, we said, okay, America first, it's not that much about America. It's about how other countries respond. And there is one that wants to compete, not just on trade and tariffs, but also on capital and on technology, on AI. And this is China. So I think that it was, I will not say that they write off their exports to the US, but they are prepared for this. They know that they only have one adversary in this race for, let's say, global, wouldn't say hegemony or leadership. I don't have the right word, but you see what I mean. I don't imagine that China would crack under pressure, especially as they know that the pressure from the bond markets, I'm not talking about the stock market that much, could lead both President Trump and Chair Powell to think twice before raising the odds further, because the level of debt of the US, the central role of the treasuries in the global financial system. I don't think that the Fed would take the risk of further destabilization of the financial system, and I don't think that what does Trump want from markets? Lower dollar, lower oil. He has this, and lower yields. It started like that, not anymore, and this is probably one of the things that helped him finally come with this 90 days truce. When was it? Was it 2 days ago? Time is so quick.
Yeah, it's all happening so fast. But in terms of what the Fed may do this year, there were a lot of people out there who talked about with a lot of conviction about what the Fed is going to do this year. And all of that, went out the window after the announcements that came through from Liberation Day on April 2nd. Do you think it's even worth digging into that in terms of how many cuts you're going to get this year, if at all? Because we have to see how this plays out. Even he said it in his conversation a couple of days ago.
Yeah, for sure. Well, for us, first we all know, and you know better than me because you were every morning commenting that the market expectations for the Fed, they have no issue gyrating totally from one extreme to another. So
take your point. Yes,
you know you know that better than me. Our scenario is for 3 cuts, and we are a bit. It's about inflation and employment, the dual mandate, and we can add this kind of panic button for the financial stability in case the US Treasury market would go really wide, which is something reassuring. It's not a Fed put for stocks probably, but it's something that, let's say they have this panic button. Let's forget that. Inflation and employment. Inflation, you have seen the numbers yesterday, I'm sure as I did. So far, so good. Things are fine. And we even think that there is some kind of momentum in the disinflation now, before the tariffs hit, of course. But still, things are okay. For employment, things are very good. So the Fed has all reasons to be on hold. Having said that, when employment starts to deteriorate, and it should, from the 200,000 job creations a month that we have, it's not a level that we will continue to have. The US economy had started to slow down in Q4 last year. I mean, it's not just post-Liberation Day. We look at the University of Michigan sentiment today. It's all about the sentiment because tariffs will hit on inflation at some point, of course, but the hit on the business and consumer behavior is already with us. And it's the tariff, and it's also this uncertainty. If you're a company, you plan to make an investment, you just don't know what's going to happen. I'm not talking about the following quarter, just the next day on policy, on something vital. And it's probably the same for the consumer. We have seen the inflation expectations from consumer totally decoupling from the market implied expectation. People are scared about what will happen on prices. So this paralysis maybe a strong word, but this chilling effect will happen first. Yeah,
it's very real. I mean, I'm hearing from small business owners in the last 48 hours who've been sharing their pain and sort of frustration and fear of having to basically reinvent their entire business model on a moment's notice. These are people who've, worked years, tested their product, developed a supply chain through China. Yes, obviously depended on cheap imports from China, but overnight now you're looking at 150%. Who's going to be able to get through that? That is the kind of damage that I worry about. And that's going to crystallize in the reports that are still to come. Do you think that the market's underestimating the damage, or that, maybe a lot of stakeholders are, just because we were at the moment looking at backward-looking data, right? But it's not real time. Once we get there, we'll be able to better assess the magnitude of what actually took place.
Absolutely. And again, I refer to our global investment outlook called Winds of Change, because I'm quite proud that our key line was to say 2025 is certainly not about 2025. We don't care. And you're right, we don't care. In the same way, we don't care that much about the Q1 corporate earnings. We care about forward-looking statements. And it's all about the future. And there is a sequence, and I agree with you. It will start with this chilling effect on consumers and businesses before, I think, tariff-led inflation hits, which means that for the Fed, they could see a deterioration of the job market and reason from this leg of their mandate to cut rates, and maybe after that to keep them on hold, whatever happens on inflation. But we never know what's going to change anyway. In terms of policy, in the meantime, you have noticed that China President Xi will host European leaders in July. That's imagine that there is a trade agreement between Europe and China, and the US is on. There many things can happen, and they would react to that. And on your point on the business model, I couldn't agree more. And it raises the underlying big question. It's undisputable that some of Chinese trade practices are unfair. Not saying all of them, some of them, and there is probably some reason for the Trump administration to raise some tariffs. However, what we have seen on Liberation Day is this idea that any country that has a trade surplus with the US is unfair, which suggests, as you say, is the US going to manufacture, hair dryers or T-shirts? Of course not. Of course not. This is not the jobs that they want. So I think we will see a better reason after some time.
I want to sort of zoom in on a point you made on U.S. Treasuries, because it's so fundamental to sort of the nervousness out there in markets and why Trump moved a little bit, even though he didn't cave completely, suffering their massive sell-off, long yields rising the most since the pandemic. I mean, I keep hearing all kinds of interpretations, whether it was the Chinese or not. Was it the Chinese with the Japanese, or was it another party that, decided to do that? What is your interpretation from your years of experience? Who do you think brought yields up when Trump wants to bring yields down?
Mm-hmm. I think there is a fundamental layer, and then there is an unknown layer, and then there is a third one, which is just momentum, speculation, and whatever. The fundamental layer is that following Liberation Day, the scenario of stagflation is not outrageous, and so you have stocks down and rates up because we could see some inflation. It's a bit weird because inflation expectation, the market implied are not spiking that much, but you could make the case that long-dated yields don't go down because it's a stagflation. Then you see that they go up and massively up, and the intraday move that we've seen. I mean, to move the 10-year by 25 basis points in a few hours, you need a serious amount of billions. And then, of course, it's reasonable to think that China may be dumping, even if they don't want also their own currency to crash. I mean, they want to be in a kind of a controlled. Probably they want it lower because they have to respond to what's happening, but they want to control it. I'm afraid there are also some, I would say, more sinister things happening. Some collateral being liquidated because many investors were on the wrong side of this volatility. We have seen events that are. 6, 8, 10 sigma, 10 standard deviation. The risk models,
it's been absolutely stunning.
Yeah. And then your 0.1% probability event happens and you liquidate. And at the end of the day, the collateral is treasury. And I suspect there are things like that. And that's probably, I would probably be looking for, these kind of things in the US mega banks result that we'll have today, Friday, which is, do they see some kind of panic in the hedge fund prime brokerage desk or these kind of things?
I mean, the fear is that something or somebody blew up massively as a result of the sheer extreme of volatility that we've seen. I'm wondering what you're telling clients right now. Okay, so we've established sort of the backdrop here. So what is the game plan? How do you respond in moments like this? I understand the call for cash, all right, but now when I look at the Bloomberg Dollar Index, I don't get very comfortable in cash. When I see U.S. Treasuries being speculated that they're no longer a haven, so what does one do here?
Yeah, that's a fantastic question. And let me just add on the previous one that when it comes to US Treasuries, it's so important that there is a limit. I mean, there is a limit to what could happen because I have zero doubt that the Fed would jump in if it really threatens the financial system. And let's be clear. I'm saying we see things, but if the 10-year goes to 5 or above, like a rocket, I'm sure that this will be solved. Now, what is the plan? First, it's more important than ever to have a plan. I mean, before talking about the way we allocate, we are positioned. It's important to have an asset allocation. More important than ever to make sure that the portfolio is in line with your time horizon and your projects. It's certainly not a time to do any kind of short-term speculation. And I urge all our clients when I speak with them, please avoid any leverage, even on things that look safe. We are in an era where we have these 5 standard deviation events happening every day. So don't do that. Don't try to do any short-term speculation. It's all about asset allocation. Now, we have asset allocation templates, which are cautious, moderate, and aggressive profiles. They are built to not lose money on 3, 5, and 7 years with a 95% probability. So we're not immune ourselves to the 5% events, I must say. But they work quite well. So a few things. Currently, we are slightly defensive. We were slightly on the weight equities, so slightly only, and maybe I'll come back to that, slightly only, with currently a preference for emerging markets, because yes, China is in the crosshair and probably in trouble, but it is at least priced for this kind of trouble, while the US is still priced, 18 times is better than 21 times, but 12 times what? There will be a hit on corporate margin on what happens, whatever happens. So we are, underweight on equities, on developed market equities, while being actually neutral plus slightly overweight on emerging markets, including China, including India, because India is not in a bad position, by the way, in the current grand scheme of things. It's not in the crosshair. It's even a strategic partner for everyone. So, and the growth is not faltering, while the multiple has decompressed. So that's for the equity bit. We're overweight cash, no question, and it's about flexibility.
Okay, so cash is cash, pure cash, or cash is in like money market funds,
money market fund.
Cash like instruments.
Yeah. Money market fund. We don't take currency bets, by the way. I wish we had bought some Swiss franc or whatever, but no, it's cash in US dollar. It's for risk mitigation, also for yield. I mean, it's not nothing. The Fed rate is at 4.5, risk-free, liquid, and it's also for flexibility. Now in the fixed income area, we just made a change. We were long duration and now we are neutral duration. We still like govies, by the way, because we think that at the end, the global economy and the US economy will not accelerate, let's say, before some, maybe in 2 years, but probably not in the short term. The absolute yields are interesting, and there is a kind of a limit to the crash that could happen there. But we are neutral duration because we are scared of what could happen on the short term. By contrast, we just went overweight on high yield, and I know it sounds a bit surprising.
Really,
but
it is surprising. I have to say. Yeah.
It is because it is a cyclical asset, but we have actually cut developed market equities and thought, okay, you know what? We have reduced developed market equities by 2% and we have added 1% in high yield. I know it's not a huge move, but we want to keep the properties of our strategic asset allocation, this capital protection. So we do small move. And we said, okay, risk is much better rewarded in high yield, we think. Given the change of quality of the high yield indices, they are more double B than anything else. Given the fact that we don't expect lots of default to happen in the coming months, the sequence of cash flow, there is no wall of money coming, and you got 8.5% carry after the spread widening that you have, which is probably. For sure, adjusted for volatility, it's better than what you can expect on equities. Adjusted for volatility, you could have it a bit better. So that's where we take the risk. But we are overall defensive, and we are overweight gold. Thanks God for.
We'll get to gold.
2 years now.
Gold deserves a good 2-3 questions. So I'll get to that in a moment. But I want to start. Sure. Just unwinding the Middle East component in your recommendations, because as global trade gets rewired, and you look at what tariffs have been instated, 10% initially, obviously that gets postponed for 90 days. Where does that leave the Middle East then in your opportunity set? Or is it still too early to make any conviction calls?
It's, of course, an excellent question. First, there is the direct impact of tariff. And frankly, it's absolutely manageable because, as you said, the baseline tariff of 10% applies. By the way, the UAE has a trade deficit with the US. Okay, so we have this 10% baseline. The other that applies is this 25% on aluminum, and yes, aluminum is something part of the export, but the US part of this is also manageable. When it comes to the direct impact, it's absolutely manageable. Now there are the indirect impacts. I see 2 negatives and 1 positive. The 2 negatives are first oil prices. Of course, they are much lower. Yeah, that's a big one. And then, of course, it affects more the countries that rely more on oil prices. And again, the UAE, and we like the UAE not because we are a UAE bank, we used to be underweight or whatever, but we like it because only 25% of the economy is energy, and the rest, the non-oil, is growing at 5%, no matter what. And no matter what, cyclically, we will feel it, but it's growing at 5% with population growth, with all the structural reasons to continue. So oil prices are a drag, and it's a drag on market because our local markets, sometimes they move for the bad reasons, and especially oil is a big factor to explain the relative performance our regional stock markets, while actually their impact in earnings, its impact on earnings is not that big. So first negative factor, oil. More on markets than on the economy, but you have to be selective. And the second is, of course, a global slowdown and this chilling effect on consumer. Countries that are exposed to tourism will a bit suffer. Now, the positive that could help smoothen that is that a lower dollar will be a good news in terms of competitiveness of, especially for tourism, for events. The UAE in particular was starting to be a bit expensive compared to other places. If you are European tourist, your holidays in Japan are now 10% more expensive, while in Dubai it's better. Having said that, the long term is phenomenal, and I genuinely believe that the UAE in particular. Sorry, I'm a bit centric on the UAE, but I think that the UAE is the new free trade champion. You see all these comprehensive partnership being signed. And now we just read that there could be one with the Eurozone, which is just a massive announcement. And I think the champion of the free trade is this country, which is also a champion of diplomacy, has access to capital, to talent, to technology. I mean, it's a lot of reason to be bullish on the long term. The short term, it's about oil and risk appetite, which creates opportunity.
To kind of flesh out what you were just talking about here, because I was thinking in a discussion with a few other investors, and the debate was as to whether the UAE could capitalize on the turmoil of the rest of the world, right? And specifically led by the United States and sort of tariffs and everything else. So would that mean then that gets pushed further into real estate, for example, right? People want to move to a place where there's predictable decision-making, right? Which the UAE has really specialized in over the last, especially 3 to 4 years, I would say, from strength to strength. But the question is, after the rally we've seen in property, Dubai or Abu Dhabi, I mean, both markets are, quite similar. Obviously, one more extreme than the other. But would you say that the upside is really quite capped, and you're not going to get that big movement of capital that you got with the Russia-Ukraine war or the Arab Spring, back in 2012, 2013?
If we are talking 10 years down the road, I am extremely confident. Now, when it comes to the coming quarters, and it's just me, I'm not an expert in real estate, but what I see is that first, the supply is getting bigger, especially in the coming quarters, and second, there is part of this. You mentioned a very buoyant market, again for structurally good reason, but there is a layer of speculation, of flippers, of these kind of things that I think make it vulnerable to the cycle and to some at least pause in the acceleration of prices. On the 10-year horizon, this is an amazing place and an amazing asset class. And as you said, it's also there is know-how. I mean, the regional developers are amazing, and the entire world is coming. Now, if you ask me, but that's just a very subjective view. In 1 year from now, will we be 10% higher? I would bet against that, because there is supply, because the speculation will also be hit by the other problems of any speculation in the world in this kind of period. There is less risk appetite probably, and it's been a bit hot, but the 10-year view is absolutely fine.
Yeah, and, once there's this liquidity drain in the global system, Dubai, even though it puts all kinds of buffers in place, historically has not been immune to that, right? If you look at prior cycles where this has happened, the extremes of that, obviously 2007, 8, and 9. But in terms of, what investors are doing in the region, since you are with Dubai's biggest bank, I'm wondering if you could run us through how clients are approaching IPOs, right? Because they haven't performed well, the most recent ones at least. Are investors getting more thoughtful about the way they allocate capital because of what's happening at the moment, and because maybe the IPO hype is beginning to fade?
It's a very interesting question. For any IPO, like for any investment, we always start by saying it's certainly not a short-term speculation. Don't go in an IPO if you just expect for some reason to pocket a quick 10% gain. That's not how we do. And for any IPO, And let's say if it's just to give an exit to the succession of thousands of private equity funds that at the end have to put it to the market to make their IRR, it's something that's not great. If you're just getting liquidity for the previous investors, it's not great. And now look at most of the IPOs in our country and many in the region in Saudi, they are there for other reasons. I mean, they are there to deepen the market, to be part of the growth of the country, of the sophistication of its market. And when it's the beginning of a series from the government, which is certainly among the most trustable in the world, that keep a major stake, you invest with them. Having said that, there is speculation because you talk about our clients. Our clients are fantastic. Some of them love to play, but I wouldn't say. So this kind of short-term trading, it happens in our region. There is it's a high octane region. So you have this layer of speculation. You have these ups and downs. We like very much the region and the companies are very focused on let's say total shareholder return, including dividend policy, and that's something that we like for the UAE in particular, and including in the way we look at IPOs. It's just that. For us, this market is still not at the level of maturity for international investor as let's say India or whatever. We will get there. This is what will provide us the multiple expansion we will get because the UAE in particular, you mentioned 2007 and 8, but since COVID, it has changed of status. It is on the map of the world like one of the best places to do business, to live, to work, diplomatic powerhouse, technology powerhouse, capital powerhouse, everything. So it has changed, but it will take time. You need international investors to have this multiple expansion. So if you need time, you have to be paid to wait. And that's why we like the UAE for dividends. And yes, the IPOs, they're not doing worse than any other IPO in the world. And at least they have happened because you see that many IPOs have been suspended and that it's quite dry in many markets. It's high quality companies for most of them. Don't look too much at the short term. If you are paid to wait with the dividend, the benefits will come.
What about the roles of alternatives like gold and private credit? I did promise we'd get back to that, so here I am living up to that promise. Talk to me about gold in particular, because we've had the likes of Goldman Sachs. They upgraded their price target to $3,300 an ounce by year end, where we've almost taken that out already, and we're not even halfway through that timeline. So I'm wondering what the thinking is at Emirates NBD.
So the thinking is that first, we love gold for some time. We are overweight on gold for 2 years now. And last year it was 20%. It was also the best performing asset class. And the reason is simple. It is the reference risk-free asset. It's yield-free, yes, but it is the reserve asset. It's a role that one day maybe Bitcoin could play in 10 years, but currently it's gold. And why is it so? Because gold is no liability for anyone. I mean, it's as simple as that. Gold is its own store of value. When you own a stock, there is a company in front. When you own a bond, somebody owes you money. You have a balance sheet. Gold is a liability in no one's balance sheet. And it is the reserve asset of choice for central banks, especially since the conflict in Russia. So it is the best diversifier. We are overweight for long. Our own target, well, we are not as volatile as Goldman Sachs because they can change their target every day. They don't mind. We don't do that. We do a target once a year. So we started the year with the 2,900 fair value for the end of the year. We crossed that very quickly. Same problem. We kept our overweight. It is the key diversifier in a portfolio. While you mentioned private assets, sometimes we can be lucky to be slow. We have been slow in entering the sphere. We have modeled the benefits of private assets in an asset allocation. And if you have 10-year investment horizon, no doubt there are benefits from private equity, infrastructure, private credit. Now, when it comes to implementation, we are a bit slow, and we are not unhappy to be a bit slow because the current what happens currently in the listed world, of course, has implication on the private world. Having said that, there are many excellent private credit products that even manage to keep a significant of their benefits within evergreen products. I mean, you don't have to be stuck forever. There are some evergreen products that are so much more liquid than the real deal with capital calls and this kind of thing, which are better in terms of asset allocation because you invest 100, you don't commit 100 and then are called 2020 or whatever. And we start with this kind of products. We select those who are able to preserve the diversification benefits while being a bit more liquid. It's a long journey that has started for us.
Okay, in terms of how you get the gold exposure or add to the gold exposure, depending, of course, where you're starting in that journey, Ryan Lemand was making the point that I need to go and rent a safe or a vault in Switzerland and then physically get the gold into the vault. All right, that is one way to do it. And I don't think that is a very effective way of getting gold exposure unless I'm betting on an actual end of the world as we know it. So the way I sort of been doing it is gold-backed ETFs to at least, complete that picture. You have some real physical and then physical backed, right? Obviously, there are different flavors of ETF. You can even go to like Switzerland where you have ETFs there from UBS or ZKB, Zürcher Kantonalbank, which, it's got all the right ratings and it's kind of a cornerstone of the Swiss financial system. So these have been around for ages. Some of them obviously in Swiss francs, the others are in dollars. Wondering, maybe you have a local version as well. I mean, how does one get into gold in their portfolios at Emirates NBD?
Well, the easy way is ETFs that are backed by physical gold. I agree with you. I understand Dr. Lehmann's concern, but if you go full survivalist, you should better dig a hole in your garden and have them, because if one day you cannot access to Switzerland, you're in trouble. So, but that's just me. But the ETFs are the easy way. They work perfectly well, frankly. They work perfectly well. We also have a digital gold in our digital bank Leaf. I'm not there to make promotion, but which is an interesting way to have gold on the blockchain, and it is backed by physical gold. And by the way, bullion and how do we say, gold coins or whatever, they're also a nice object to keep, and it's also a nice way. Having said that, in our asset allocation, of course, gold is liquid. Gold has all the virtues except that it doesn't yield anything, and that there's only one risk actually for gold in the coming, for me, in the coming years. It is in case the US Department of Government Efficiency manages to materially slash the US deficit, which is, by the way, kind of a hope that I have for America, because I'm a bit of a Reagan-esque person, and I like very much this idea. But if this happens, this is negative for gold. Anything else, I see absolutely no reason to be not to hold gold. We recommend between 5 and 9%, depending on the profile of the client.
So the risk now is quite high because of the rally it's had, because it's not a conventional rally over the last year. So I also know of one portfolio manager who has sold a gold position for their clients because he says it's no longer a haven at $3,300 an ounce. Like, it's an actual risk. It doesn't serve the purpose of buffeting any future volatility.
It is absolutely, it is true. The thing is that sometimes the risk of trying to time is, if we weren't in a long-term trend where it's good to have an asset that is a liability for nobody, I would think that. And where I fully agree with you is that with such a rally, gold is vulnerable to more trouble in financial markets, because at some point people have to sell what they can to cover their losses elsewhere. And gold is now vulnerable to that. There's absolutely no doubt. And by the way, just after the worst day after the Liberation Day, I'm sure you had noticed that gold was down, which was fundamentally a bit weird, especially for that. You could see some profit taking. Actually, we also do technical analysis, quite sophisticated quant tactical analysis. And we had 2 or 3 times where we had signals saying, no, gold is overbought. We should sell it. And we didn't, because we were lucky, because we were really convinced, it is going to come down. There are all reasons to see gold being vulnerable. If we have further disruption in financial markets, at some point it will break, which will be a buying opportunity. That's the thing. And we are a bit scared to be wrong on these downside risks, so we keep a 1% overweight on gold.
What are we doing with cryptocurrencies and Bitcoin in particular? I mean, what we've learned in the last few days is that it's actually not the kind of asset you want to own in times of high volatility because gold is outperforming it meaningfully. But obviously, that's a story that's still being written out. Are you staying away from any exposure to crypto? I know Emirates NBD is a bank. Obviously, it's done a lot of innovation and experimentation. So I'm wondering to what extent that trickles through to you making actual recommendations.
Well, first, we offer access to our clients who want to trade it. But in an asset allocation, you're perfectly right. It's against gold. And I wish you were at our broad show because we had a huge bit, and it was in January, saying that gold is a better diversifier than Bitcoin for the time being. And that last part is important. Currently, Bitcoin, in an asset allocation perspective, you look for diversification, you look for uncorrelated sources of return. And currently Bitcoin is pretty much the risk appetite, the Nasdaq risk appetite on steroids, which is fine. And which is not fine because Bitcoin deserves to be better than that. I genuinely believe that this will be a credible, maybe even an alternative to gold to some extent when the volatility will be reasonable, which is not the case. Currently, it's a speculative asset, so it is correlated, so it doesn't work as a diversifier in an asset allocation portfolio. We prefer gold. In 5 or 10 years from now, you have all the attributes of a store of value. And in this case, Dr. Lehman wouldn't even have to open a safe in Switzerland. You can just have it directly on your blockchain with your private keys. And I think it's another asset that is a liability for nobody. The proof of work, it's very similar to gold. Gold is proof of work at the end of the day. It's the work that has been put to extract it, except that half of gold has an application in jewelry, 25% is in the central bank reserve. So out of this 20 trillion market cap, Bitcoin will not go there. And even a quarter of that, which is gold held for investment, 5 trillion, it means Bitcoin at 250,000. It could go there in 10 years when volatility is in line with gold and when it's less speculative.
So for those who are making the switch from, whatever it is, Singapore to Dubai or London or Zurich, Geneva to Dubai, having lived through it and having been here now a few years, what advice would you give it?
In terms of lifestyle or?
Yes. Yeah.
Yes. Oh, it's, I think, I don't know, you're here for long as well. I could ask you the question. For me, the beauty of the place is that it is the freedom, which is funny because I don't know for you. When I came here, some people were saying, "Oh, really? You will not? There are restrictions and everything." But I think it's the absolute opposite. There are very clear rules, and for the rest, you are free to have the life you want. I am a father. I'm a very quiet family man. I have the best possible life in this segment that you can imagine. I walk my dog. It's beautiful. If you are a party animal, you can. If you are an entrepreneur or willing to work night and day to create the best startup in the world, you can as well. If you are an investor, if you are, that's the beauty. So I don't know if I have any advice apart from forget your preconception. Just come and make the life you want. Yeah.
So where's home for you then? Because I struggle with that today. I know a lot of other people struggle as well because they find so much in Dubai. And then when they go home, it's, also changed. So is home for you now Dubai or is it still back in Europe?
It is Dubai, definitely. Even if I am French, I can't hide it with my poor English in particular. But
it sounds pretty clear to me. So
France is in my heart. I'm French forever, but my home is Dubai. Yes, definitely, because of the amazing. It's the same for you. You have the feeling you contribute to something. We work hard, but what we get in exchange is disproportionately fabulous. In terms of quality of life, and people believe in the future. And I'm just hoping for my perception of France, but it's something that people are a bit struggling with here. You believe in the future. Yeah, my home is Dubai, definitely, and I wish I could stay there forever, but you never know. But I'm French, quintessentially French, and that's also, by the way, it's interesting when immigration is such a topic in the West. You don't have to look very far, just look at the UAE to see how immigration can perfectly works for everyone. Providing benefits for the host country as well as for the migrants. We are migrants at the end of the day. It's just there is the right way to do, and it's full of hope. And I love this positivity. Yeah.
What kind of investor are you on a personal level?
On a personal level, I am very disciplined. First, because that's what I recommend to others. So I wish everyone could be differently. And second, because that's really following your previous question, because at some point I will have to buy a home, which I haven't done. So I'm quite conservative with my money.
You
because,
haven't done it yet? Okay.
No, I haven't. Which is not don't follow this advice. That's for me as a wealth management. So I'm quite conservative with my money. So I have cash, I have gold, and I have a bit of Swiss franc, which happens to be brilliant this year, but it wasn't the previous. And so as an investor, I'm as I know that one of these days I will use all my money to buy a home, I don't take risk, and as simple as that.
How should investors manage sort of the volatility in these markets? Because you're trying to balance greed with fear, right? And when you speak to clients, I mean, a lot of them are obviously can be very enthusiastic or very worried. You have both extremes of the spectrum. How do they manage their sort of biases? What kind of tips do you give them?
It's a constant fight that we have between the discipline that works. We all know it works, and even we all know that if you put some money in a very simple tracker every month, that it works perfectly. Still, people go and say, "Oh, you know what? I think I will jump in this thing, or let's try to do some quick buck on Bitcoin or whatever." That's human nature. Now, in this kind of situation, it is very interesting because at this level of the behavioral factors such as implied volatility or even investor sentiment, we are at extreme. So it's quite obvious that the returns from these levels of almost panic, the returns in 3 years should be good. Now, I always say don't buy anything that you wouldn't buy if you were stuck with it for 1 year, never. And don't sell something that you intend to buy back when it will be lower. It's just a matter of, I think it's a good time to adjust positioning, especially on risk asset. Let's imagine, for us, a moderate investor, which is a 5-year time horizon, we expect something like 5 to 7% expected return, no loss after 5 years. You should have around 40% equity. If by chance you are at 25 now, it's not a bad time to progressively go to 40, and just don't look at what happens the next week. However, if you're at 60, it's an issue, and I recommend you cut ruthlessly without hoping for something to make it up for your losses. I mean, if you're really a moderate and if you should really be at 40, be ruthless with the losses, but take risk because you have the time and the portfolio structure to do it. So it's not about will it be right to add this 5% equity in 2 weeks? You don't care. You know that it will be right in the 3 years.
Absolutely. And what advice would you give young investors who are starting on their journey today? Is it sort of a broad fund and just, do automated investing? Is that the way to go? And if you want to do a few bets, do it with a very small size of your position, right?
Yeah, you've nailed it, and I'm sorry to be. I won't be very original. It's a typical daddy's advice. Yes, you put 10% on your earnings every month in a tracker. Okay, it could be S&P 500, could be MSCI World or whatever, and you look it grow and go down sometime, and you look. It's all about the beauty of long-term compounding returns. That's the only magic. And I think Einstein said that it was the most powerful force in the world, and it is. And then if you can't help playing, yes, do a satellite portfolio, play with crypto, because in crypto you can play with a very small amount of money at the end of the day. That's also a way to learn. You learn through mistakes. So it's better to make a mistake with 200 dirhams than with your entire savings. So
agreed. How has AI found itself into your routine or into your research, be it ChatGPT, DeepSeek, or Grok even, or you don't use any of them much?
Actually, we use no, I will not name names, but so in our job there are two things. There is the kind of a research part, which is about thinking about what should happen, and we take the decisions. For the decision making, we are trying. We have quant models, so from quant to machine learning and AI, there is just one step, and currently we are not ready to leave the machine take the decision. Let me be very clear. It doesn't work work much worse than human being, to be honest, but it doesn't work better. And the difference is that when you have a human being in front of you, he can tell you why he did this right or wrong. While the machine will tell you it's the machine. And so you need the machine to be much better than the human to trust it for the decision making. Having said that, where it's fabulous, and especially for me, is that we read maybe 2 or 3 hours per day, because we read tons of reports of sell-side research, of company reports, of news. I mean, even books, geopolitics, or whatever. And to that extent, being able to upload a PDF to one of the the AI assistant that you mentioned, and ask him, okay, please make me 200 words resume, and please tell me if there is any mention of this. That's fabulous. And I guess for company quarterly earnings and all their reports, it's amazing. It's amazing. I used to read like 3 or 4 only because they are so big, but the information is so interesting. And now you can go through 20, 30.
It's absolutely life-changing, that's for sure. Maurice, this has been a real adventure, so thank you for joining the ride and running us through some of your real-time ideas. Maurice Gravier, the Chief Investment Officer at Emirates NBD. And if you haven't yet, please hit the subscribe button so we can keep you up to date with new episodes. Thank you for watching.